Right, everybody, welcome back to another episode of Talks with Finthentic. I'm very pleased to have with us today Marti and Alain from KomaLogic, which I've known for a couple of years. And we wanted to do a talk with them because KomaLogic has been spending a few years now developing strategies, collecting assets under management. And from the little I know, we'll explore it on this podcast. I believe they've been doing it in a very systematic, very professional way due to their background as quants, as developers. And it's interesting as a retail trader to get some insight into that. So Marti, Alain, thank you very much for joining us.
Thank you guys for inviting us.
Thank you.
So let's jump straight into it. We have a few questions regarding developing strategies, optimizing them and such, but maybe you want to give us just a very quick intro to KomaLogic and what you guys do and what your goal is, and we'll jump to the algorithmic part.
For sure. So right now we are a team of 5 people that are building a systematic trading firm, which only uses statistical and mathematical models to build strategies that are coded inside an algorithm, which means that they are systems, algorithms that execute always on the same rules and with no human intervention. We have the alpha models, the risk management models, also coded into algorithms that execute on a collocated server. And actually, that's what we do. We try to model the cows in the market with the statistical tools and put them inside a box, and it executes automatically.
Amazing. And from what I've seen some equity curves. You guys are doing this, I would say, very successfully. So when somebody wants to develop a quant strategy, let's say I'm coming to this as a like many traders, many retail traders. I'm coming to this as a purely click and point trader. Where do I start? Explain to me like I'm 5. How can I start dipping my toes into this world?
Okay. Normally, when a trader starts, first of all, he has to know why we want to start. Maybe he has some videos on social media, which is kind of difficult, the message that you get from social media on what trading really is. But let's say that this person has already traded in the markets and has experienced that this is not an easy task, and you need to take it seriously. The first thing I would say, and this is, of course, based on our experience, which is by no means the truth, but at least is what it worked for us and hopefully can work for other ones as well, is to, first of all, try to systematize what you do in the markets. Why is that important, the issue of systematizing? Because you need clear rules and a clear path and a clear step-by-step checklist to follow. Because when things get wrong, that they will be, you at least need some kind of rules, boundaries that you can use so you don't do crazy stuff. And the other thing is that once you have clear rules, you can test those rules in the past, which at the same time is by no means a warranty that they will work in the future. But if you have some confidence and some numbers that your strategy has worked in the past, it will have a chance to work in the future. Because if it has not worked in the past, maybe let's go to do another thing, because for sure it won't work in the future.
Right. That definitely makes sense to use the data that we have, the historical data, and move forward with that.
Yeah, actually, what we've done is just, Marti and I, we have a scientific background. So the only thing that we have done is just bring that science methodology to the trading, just analyze the data, and then came up with specific rules in order to know if the things that we are doing are the correct things or not. We can measure if we are doing well or not, and that's the key. Just try to systematize your methodology, and then you'll know if you are doing the things right. And just the only thing that splits you from the success is the time.
It reminds me a lot of the book Atomic Habits from James Clear, the way you are acting. So the follow-up question will be the importance of backtesting and the importance of forward testing. As traders, we can relate that it's the most important thing. So how do you go about in that type of situation?
Yeah, so you've covered the importance of backtesting, and now how do you move from you've back tested, maybe you can touch on cherry picking, overfitting, and also how do we move forward into the live world with this model?
Yeah, this is the key, absolutely the key. Because first of all, I have this book on my collection, so a very nice recommendation actually. Atomic Habits, yeah.
That's a great book.
One of the things about backtesting is that okay, let's see. It's extremely easy to make a backtest go up and to lie, to make a backtest lie. The thing is that if you torture enough the data, it will tell wherever you want the data to tell you. This is a famous quote. I don't remember from whom, but it's not mine. But the thing is that once you have knowledge about what has happened, it's very easy to target rules to exploit exactly that behavior. And that is actually the definition of overfitting. What you're doing is to really model the noise in the data. So the backtesting is a pretty simple concept, but not an easy task to do well. You have to bear in mind, first of all, that your data is clean, because if you have mistakes in your data, this will become to mistakes in your backtest, and finally to mistakes in your logic and your decision making. Then you need to make sure that you take your data, your available data, and put and divide this data into training and validation sets. If you want, I can explain briefly on that topic.
Yes,
because
please.
Okay, for example, let's say that you are trading the S&P 500 for the last, I don't know, 20 years, and you don't change, you don't separate your data into training and validation tests. This means that what you will do is design trading rules, and you will then test those rules against that data. If you use all the data that you have, and let's say that, for example, you say, okay, I'm going to use a moving average as a trend filter. Okay, nice. And I will choose, I don't know, 25 as a period. You cherry pick that period because it's the one that worked best in the past. And then you don't have validation data. You cannot test this parameter against data that the strategy has never known. And this is extremely important because it's very difficult that the best parameter in the past will be the best parameter in the future. Just by the random chance. I mean, the past has already happened, but by no reason, when you target and choose the best parameter in the past, what you expect is that the past is similar, that the future will be similar enough to the past. And this is not always the case. So it's very...
Is it something like a hindsight bias, like if you only use the backtesting?
Yeah, because what you ultimately do is to only choose the strategies and the parameters that work well on that particular set, but you won't have any way to test if that was overfitted or not. And one of the ways that you have to test if there's some level of overfitting, and always there will be some overfitting on the strategy. There are different kinds of overfitting also. You need those validation data. If you search in Google Images, for example, overfitting graphical explanation, you'll see what it means, and it will be extremely clear. Once you have a model that, let me rephrase it. It's a pretty dense thing. I'm trying to condensate it in an easy way. But if you have an asset that does this, and you choose the specific moving average that buys on dips and sells on the highs, the specific one, the backtest will look amazing. But then on the future, this asset won't probably behave the way it did in the past, and the parameters that you choose will not be the ones, and probably it will be a loser strategy.
And your answer to solve this is by using validation data to kind of get better insight into, let's call it a semi-forward test or a test of randomness going ahead.
Exactly. This is one of the ways, because the other thing is that when you design a strategy, you have what it's called degrees of freedom, which means if you use, for example, a moving average, let's say an RSI indicator, a stochastic indicator, each of those indicators have parameters that you can change. You can put parameter 1, parameter 3000, whatever. The more degrees of freedom, meaning the more parameters you have to change, the more data you would need to statistically validate that those test results that you're having, you can believe them. So to avoid overfitting, for our listeners, we can say that use a large enough amount of data, divide those data into testing and into training and validation, use the least amount of degrees of freedom. For example, in our firm, we use maximum 2 degrees of freedom.
Mm-hmm.
And with all that stuff, you have a chance of not having an overfitted system. And I mean a chance because, for example, if you know that trend following works, you are introducing a tacit overfitting in that strategy design process.
Yes. And you looking at backtesting, I mean, just an easy example to cherry pick is you look at a period where it was the phenomenally trending market, and in difference from, I think, the market that we've had in the ES mini over the past 4 weeks, 6 weeks, it's been a very choppy market. And I think this is part of the challenge, because you do this as a manual trader. You have to understand when it's better to trade the range, or I might have a trend day, I'm gonna try trade the momentum. Before you even do this, you have to identify what kind of trader you are. But you have the discretion to flip that at any time. You're using the human discretion, which is, it's not black and white, it's subjective. And in your system, I assume as a manual trader, you would need to have more black and white, a moment when I'm going to change the model and why.
The thing is that for a computer, which is ultimately the thing that executes those trading strategies that are coded inside an algorithm, there's no gray scale. You have to give the computer absolutely objective rules, closed rules. So you have to define, if you, for example, want to define what's trending, what's range. For example, you can use, for example, Gaussian mixture models to define what is a ranging market or a trending market. It's called market regimes. But you need a boundary. From now on, this is trending. From this before, this is ranging. And this is also one of the needs that on your training data, you need to have as many different market conditions as possible, so your strategy sees all them.
Thank you, Marti. That seems like a lot of alpha there. I would like to ask also regarding the technology, because what you are saying now, I'm sure the audience will say, oh, they might need a perfect technology infrastructure. I mean, what is your perfect infrastructure at the moment, if there can be a perfect one?
Yeah.
Okay.
Well, maybe Alain can. Yeah.
Yeah, of course. Right now, we are using for our technology, we are based on MT4. So we're using our MQL4.
MT5, sorry.
MT5 also, sorry. Just me read it. And yeah, what we have is our own framework where we develop, different libraries, different classes, and so on, in order to make all the stages and the steps that we take in order to validate and strategy. So it's not like a huge amount of different technologies. It's just one, MT5. But yeah, there's a lot of different libraries and different classes that makes possible to test the strategies easily for now. But I mean, it's the natural way to grow. I mean, we started by creating the strategies, in a plain script, in QL4. And after that, we thought maybe it's not the best way to do this. Let's divide this in classes, and then we came up with the framework. But this is the natural way of growth.
In execution-wise, though, did you have any other infrastructure for that? Okay, so
right now, as our costs are now very high, I mean, we have only a server with MT5, sorry, and we execute there our algorithms. That's the only thing.
Yes, so
Alain, I'm not sure the strategies, if they're more momentum. I'm not sure your time frames, but maybe it might be interesting for our viewers to hear, if you want to do something very HFT or very scalpy, some potential challenges, and that might mean I have to do something slower. It might mean this is possible or not.
Yeah, of course. And our strategy is not so fast, so we don't need really fast technologies. I mean, we don't need a real-time connection with the server. We don't need big data, for example. But in that case, yeah, you shouldn't. You would need a really. I mean, you should be close to the providers the most close you could. You also, instead of using MT4 or whatever, MT5, maybe you could use directly a fixed API. I mean, a fixed connection, directly implement it in WebSockets. I would recommend not using Python, for example. Maybe you should switch to another languages, C-based, like MQ4 and 5. But I'm sure that you may use a fixed API, almost sure. I mean, you have to communicate with the servers directly.
Much more instant requests, right, from when you're using a fix.
Yeah.
In general,
yeah,
we know.
If you need low latency, yeah.
Absolutely. All the institutional players are executing over fix. So coming to that, fix and MT, is it possible? I know the answer you will give me, but for our listeners, is it possible for retail traders to come to this and develop winning strategies, develop an edge, and become algorithmic traders? As speaking as somebody retail, you didn't come from an institutional background, you don't have some special technology, you don't have zero latency, you have all the challenges that we come with to the market.
Yeah, the answer, of course, is yes, because we ourselves started as retail traders, and we just kept on learning. As Alain told you before, yeah, we come from a scientific background, but this doesn't mean anything. It only means that the technological part and the coding part is our advantage, but all the other knowledge we had to gather it by ourselves and test it with time and experience. Another thing, right now you have incredible platforms out there. For example, MT5. Yeah, it's a retail platform, but the platform is just the excuse to get to the market via your brokerage service. What is important is the logic, which is behind. You can execute via the TWS from Interactive Brokers or via Bloomberg or Refinitiv Terminal. It doesn't mean anything if the strategy is not good.
So this is strategy.
Exactly. This is the first thing. If sometimes retail traders think that they need like the most flashy and expensive technology, and that is by no means the truth. You need to be very cost effective on your infrastructure. As Alain told you before, we have only one production server, which is duplicated. If one fails, the other one automatically goes up, but we are paying just for one server. And then we have all the analytic and research platforms locally on our laptops. I mean, you don't need huge amounts of expensive machinery to run all those things.
Clear.
And based on the alpha generation, there are, for example, Perry Kaufman books. They are full of strategies that work, and you can start there.
Okay, amazing. Share me some links, and I'll drop those in the footnotes, as well as I think what would be very interesting, just before we go to quick fire rounds, what would be very interesting, and I would like to include these links as well for people to see your equity curve and kind of how you've developed with this. But the fund itself, is it open for somebody if they want to invest in it? Is it a closed fund? Can someone get exposure to your strategies if they would like to?
Yeah, absolutely. It's open. We trade via Darwinex, which is a broker from Spain, regulated by the CNMV from Spain, and also the FCA in the UK. And they are really an asset manager that has a broker inside by necessity. And what we have is called a Darwin, which is like an ETF, which is open to the public, and you can see publicly the track record, all the numbers, and there's nothing hidden there, because as money managers and for investors, the most important thing is transparency. And I will for sure give you the link so everyone can see it. We have right now 12 investors with, let me see, 60K assets under management. Our cumulative returns since we started on 2020, this strategy on that broker, is 51% right now. And it's 100% momentum strategies working on the FX market long term. Our holding periods are around 1 week, so our trades we trade. Our trade frequency is pretty low because we want our trades to be very cost effective and with high efficiency, and we seek what is called swing traders. So we are trend followers on that time frame. Yeah.
Got you. Andreas, any long form questions before we jump over to quick fire round?
I was about to ask, but he gave all the answers in one question.
He answered a few right there. Yeah.
Yeah. I think they're very transparent. We can add that we met the guys 1 year and a half ago in Dubai, if you remember. We had a very fruitful conversation, and we always mentioned on partnering or doing something together. We are working somewhere in a different project at the moment, so this is why we said it would be great to bring you on and provide us with the alpha. I can tell you for a fact, and I'm sure Alex can vouch for that, we talked with many, let's say, algorithm traders, professional traders, and etc. Not many will give the information you give, so we really appreciate that. That's
yeah, and you can kind of see the degree of how serious you take this, and you're getting this from two traders that are purely manual traders. So it's interesting to see the other side. I absolutely agree with the requirement of having rules in place. Even if you're a manual trader, you need to have everything as systematized as possible. I agree with what you said about you have to know when the regime has changed and you need to adapt your trading to that new regime. Hopefully you have a tool set that's been tried and tested for the new regime. And now quick fire round. So I'll ask you each, I'll ask a question, then maybe Marti, you can go first, Alain, you can go second. Which is your favorite instrument or pair to trade?
Okay, for me, it's yen pairs because they're the most trending, at least by our research.
Okay, from my side, I don't have any preference. I mean, I'm more from a techie part, IT part. So Marti has the knowledge about really how to trade, and I really use them as data. I just process them. I just get the data out of them. So I don't have a really specific, favorite pair or whatever.
Who is mostly right between you two? I'm just kidding.
Probably Alain.
The same model.
I was about to tell you, it doesn't have any emotion, so that's good. That's good.
I think one which would be interesting to our listeners, the answer might be the same, but again, we'll let you answer it each independently, is how much leverage do you typically use? It can be a range when you're in any trade.
Our maximum leverage for the portfolio currently working, maximum leverage is 4.
Okay, that's interesting.
Very, very low compared to what we see the vast majority of retail traders to use. So I think there's a lesson in that. And then finally, which I know now you're executing NT4, but which has been, maybe there's specific reasons for that, which has been your favorite platform to use for algorithmic trading?
I would say in the CFD space, because it also depends on what you're trading, MT5 is pretty good. The code and the possibilities with MQL5 are huge, really huge, and it's very powerful. And if you combine it with Python, you will have, almost everything you need. And I would say that easy to use and retail facing, MT5 is a very good platform. TradeStation is another very, very good platform. And ultimately, TWS is good if you don't see the platform, which is ugly.
Yes,
but if you interact with the gateway.
Brokers, just for people to be clear,
I completely agree.
Do you agree?
Yeah, I completely agree with Marti. I mean, 1 year ago, back then when we weren't using MT5, I will tell you that MT4 was like my favorite platform, but now it's MT5 because from Algorithmic's perspective, it's more robust. It has more libraries and so on. I've also used TWS, and for me, it's a good alternative. But for example, integrating with Python, it's a little bit more tricky. But for me, the algorithms, like the strategies out from the platform, and right now the easiest way to integrate with the platform is via MT5. So yeah, it's my favorite.
Perfect. Okay, guys, I guess we'll close it at that. Again, thank you very much for joining us. All those links, so links to the books which Marti recommended, links to their strategy, which is open. You can see it. You can see the returns. You can choose if you wish to get involved, or maybe you can just use this talk to get started on your own algorithmic journey. Thank you all very much for joining us. Bye-bye.
Thank you, guys. Bye-bye.